Hi, folks. You're with it today at your Pushback channel, and thank you for joining this radio live stream. In this essay, I'd like to talk about the relationship between the stock market, which has dived, around 22%, I think it is, from its high point a while ago. The interest rates increasing, the issue with interest rates and the effect they're going to have on house prices, and how house prices are already starting to look a bit shaky in some places, and also to look at inflation and what we can term intrinsic value of an asset. An asset can be either a house or shares on the stock market, and any tradable assets such as bonds and the like. So this is all part of a wider picture here. Now, when interest rates hit zero in the early 2000s, it wasn't possible to make anything resembling a decent return from any interest-bearing type deposits or accounts. Now, given the US dollar is kind of the world's reserve currency, although that looks a little bit shaky at the moment, there's a lot of money washing around the United States at any time, not simply domestic funds, but offshore funds, German investment funds, Japanese, Chinese, you name it, it's going around there. Now, the S&P is the biggest, most liquid market or was then, stock market, trading share market in the world. So there was a lot of cash washing around, trillions washing around in these tradable assets and in these share markets. So because the interest rates went to zero, it wasn't possible to make money on, as I say, in anything interest-bearing. So the money went into the share market and into property. Now, interest rates that low for that duration is a very artificial situation, not reflecting market forces. And that's one of the big things we have to understand about the globalists. They've decided market forces create a level of uncertainty that they cannot tolerate if they're going to implement the globalist project. It's a bit like elections and the rule of law and due legal process. They create uncertainties which are unacceptable to the globalists. So, and we see this going back, as I say, close on 20 years now, if not a little bit earlier, but certainly 20 years ago. Now, they did a few things, the globalists. They kind of juggled the balls and kept them in the air, and did an impressive job of keeping the balls in the air, given how much they were screwing with the economy all across the Western world, US economy included. So when we look at the stock market today and say, well, gee, it's dropped 22%. I mean, wow, that's like, whoa, fuck, Black Friday, Great Depression, 1929, we're all screwed. And that's really what we need to understand is, given interest rates have been so artificially low for so very long, pushing 19, 20 years now, because they've been so low for so long, there's a very artificial amount of money has gone into the share market. So it is very artificially overvalued, way beyond intrinsic value. And we've seen absurd sort of developments in the stock market where shares have kept on going up in price, even though while volume of shares traded has dropped away to almost nothing. So the other side of it is that the big pension and retirement funds that are all controlled directly or indirectly by the big banks, they have acquired vast sums of money. So they effectively decide what a share price will be. And they can go to any CEO of pretty much any company and demand, appoint our friend to this job, do this, do that, do whatever. And if you don't do it, we'll tank your stock. You'll never get a bonus. And because we're the biggest shareholders, we've got a lot of clout on the board, and we can make sure you lose your job. So they've amassed a vast amount of power and clout all across corporate America. And I'll come back to that. But that's added to the, if you like, the overvaluation. Now, by the estimation of most people, intrinsic value of stocks, it's around 40 to 45% of the current market rate. Some are even saying closer to a third. So what this means, if the stock market halved from its high point, halved in value, the S&P 500 as an example, even if it fell by 50%, it would still be well overvalued compared to intrinsic value. Now, a lot of the organizations that form the basket of companies that make up these index, not just the S&P, but the NASDAQ, Dow Jones, and so on, a lot of these companies enjoy very privileged access to government business, so taxpayer money flowing like rivers into their front door. A lot of cartel pricing, a lot of oligopolies, a lot of monopolies. A lot of these people, a lot of these companies have been able to avoid competition, whether it's competition to say hire workers and access inputs to business, or whether it's access to customers. They've been protected on both sides. They're allowed to bring in cheap workers from the third world, which artificially depress wages and artificially boost consumption, and that's a big issue. But also they've got, as I mentioned, privileged access to many markets, many customers that they didn't have previously. Also, they've been permitted to send jobs offshore to countries like China that don't have anywhere near the industrial or clean, environmentally clean methodologies and practices that are required in the United States or the West generally. So they've been able to offshore that work and thus reduce input costs, whilst not in proportion reducing the retail price. Now, also with sort of manufacturing and well-paying jobs going overseas, with the easy access to low interest credit, and I don't think it's ever been in the history of the human race ever been so easy to access credit at low interest rates. Because of that credit, then retail and services have received an artificial boom. This too is artificial. It's not market forces being driven. It's artificially being inflated and supported and pushed by these low interest rates, which I say have been around for close on a couple of decades now. So there's been an artificial boom in bullshit jobs in like takeout food and cafes, retail stores, Walmart and that sort of thing. Now, a lot of these jobs pay even barely a subsistence wage, but they're jobs. They appear on the jobs list. So, or the quantity of jobs created and this sort of thing. Even though, I think something like half the US population are really now paid marginally above or less than subsistence. So that gives you an idea of the boom in jobs has come not on well-paid jobs, but on piss poor paid jobs. Same could be said for importing a lot of these programs from places like India and so on. Certainly the programs I've hired and worked with and noticed, they've all been useless. I don't think any of them have been any good. But we're all supposed to believe they're genius programmers and they're overrepresented among CEOs because they're so fucking brilliant. That's nonsense, absolute nonsense. But it's had it's depressed wages, and it's also allowed Indian labour hire firms and so on to offset expat taxes and the like. So these people, even though they're paid a lower wage, if they organise their expat taxation, like income taxation properly, then their income is the same or even better than an American worker, say, making $25,000, $30,000 a year more. Anyway, the whole thing is that it's all these activities have taken intrinsic value and real value out of all business dealings, market transactions, share market, house prices, and so on. For example, in Australia, house prices have increased at almost 3 times the rate of income. Now, if you've got fewer people who have enough money to buy a house, then demand declines and thus house prices fall. But instead, the opposite occurred. As people had less and less money and could less and less afford to buy a house, house prices went up at 3 times the rate of wages. Now, there is a difference there insofar as they could borrow more and things like that. But nonetheless, people with less money can't spend more money. The loans and the bigger mortgages notwithstanding. So that gives you an idea that as the purchasing power of the local people was falling, declining, disappearing even, House prices kept on going, but they weren't selling to the local people. They were selling to offshore syndicates who may have used local nominees, but they were selling, houses were selling to the big banks, the Black Rocks and those sort of guys, and to Chinese and Indian buying, rich Communist Party generals or rich Brahmins with juicy monopolies in India and so on. They were buying these properties and buying hundreds each at a time, that sort of thing. Massive investment. $20+ billion every year into private residential real estate, just from a handful of rich Chinese people. That gives you an idea of the scale. But the reason I mention this is to illustrate how far this is residential house price, went above the purchasing power of the local people. And I say that again to illustrate the fact that market forces everywhere broke down. Market forces no longer represent real value, intrinsic value, or what people can afford to pay or what they want to pay. That's all gone. It's disappeared, and the globalists have pretty much squeezed it out because they needed a certain level of control and surety for their own globalist implementation plans, which meant they had to, as they saw it, go down that path. Now, so we've got all these interlocking and interrelated things. We've got a share market that's overvalued by 55 to 65%, depending on who and that's above the real value, by the way. So if it goes down by 50%, 60%, it's not even a crash. It's just coming back to real value. That's how overvalued the stock market is at the moment because of the low interest rates and because it's awash with cash from these, for example, the big investment funds. I'll just mention something. There's a talk, but the law is that the company management must represent shareholders. Now, when that law was made, it was the end of the days when shareholders represented, mums and dads and small investment firms, small brokerages, these sorts of things, all across, for example, the United States. So there could be millions of shareholders, not a concentration of big shareholders, but rather millions of shareholders that held, 0.25% or 0.5%, that type of thing. Now that's changed. Now you can have 4 or 5 big funds, all who know each other, who are all married into each other, they're all up each other's ass and all that sort of thing. And these big funds control the whole, pretty much, certainly a majority of shares, of voting shares, but would control probably all of it or close to all of it, 80, 90%, that sort of thing. So they've got tremendous clout, these people, as I mentioned earlier. And that wasn't how the law to represent shareholders was meant to work. It was meant to be hundreds of thousands of mums and dads owned the shares. But now, as I say, it's 4, 5, 6 outfits like the Black Rocks and the State Streets and so on. They're the ones that own all the stock, and they're the ones that decide what goes. They issue their orders, and they're globalists controlled all these places. They issue the orders to the CEOs and to anyone else involved in that exercise. And that's why, or that's how, the law now to represent shareholders. Excuse me. All that means is, I had a cup of coffee and went down the wrong way. All that means is that the shareholders now are just the big money guys, the big end of town. That's the share. So the management actually is meant to represent the interests of these already mega rich corporate fucking barons, globalist barons that decide everything. I don't think it's ever been that close between business and big finance, and now all in the pocket with government and the globalists and so on. So it gives you an idea to how that side of things came together. The law saying that management represents shareholders, that needs to, in my view, that needs to change. Because all it means now, as I say, is it represents the big end of town. So we've got all these overvalued assets, whether it be housing. Again, housing in Australia could come down by more than 50%, and in fact probably closer to 60%, if it's going to be in line with the purchasing power of the local population, rather than offshore gazillionaires that are artificially pushing up the price. And I've gone to auctions, housing auctions, and the local people, the local white people are dropping out, in the first couple of bids, and then it's all Chinese and Indians and so on that are doing the bidding as they head to the finish line. Often the bidding is 50%, 60% above what's considered to be the expected price. I've seen places that have gone up for 850 and sold for 1.4 million. And these people don't care. They're so cashed up. They just go from one auction, one sale to the next, to the next, to the next, just casually bidding until they get it, and off they go. Not a beat of perspiration. Not like the local, mum and dad with a little kid wanting their end of the property ladder with their first house. They sweat on every. You can see the terror on their face. Not the black and brown people that they're having to compete with. They're very cashed up Chinese and Indians that they're competing against. Those guys just keep on putting their hand up. Yep, got it. Next. So this is where certainly a primary part of where the overvaluation comes. So really, for the economy to come back to reality, that is intrinsic value. Market forces driving it. The stock market and the real estate market need to fall by 50 to 60, 65% just to return to intrinsic value. Now, not every single share is overvalued by the exact amount, so that's an average. Some shares need to drop by 75%, others could drop by 35% to get to intrinsic value. But to give you an idea on average of the scale of the overvaluation that's been allowed to occur. Now, this should have been stopped a long time ago, but all Western governments, under the direction of the globalists, just kept on kicking the can down the road and trying to sort of, let's find a spot, let's find a moment when we can pick the can up, when we won't endanger or undermine the smooth implementation of the globalist project. But now I think they've got no choice. They realise that no, we can't do that anymore. So what we've got to do is threaten and intimidate people. Take the guns away, do this, do that. Accuse them all of being Nazis. So that I think they've switched to that as the new method of fixing the economy. Excuse me. Now, inflation. Just looking at inflation now, the inflation has been caused recently. I think the artificial holding of interest rates has played a role in that. Holding it down low has certainly played a role. But they probably could have worked their way out of that. But they've either didn't realise how far it had gone, or they fucked themselves up. Probably a bit of both. But the inflation, the primary driver, in my view, of inflation was that people were being given during the COVID pandemic were being given money to stay at home. They were told, you can't work, you have to stay at home, but we'll give you money. We'll give you money to pay the bills. Now, what that meant was productivity just went off a cliff. It just sank to nothing. So money's still being spent. Taxes aren't being gathered because there's people aren't working. Businesses are being closed, so they're not paying taxes or paying their workers, so productivity fell off a cliff, or was driven and pushed off a cliff, I should say. But people were still being given money. Now, whenever you give out money and people can purchase things, but the productivity dives away to almost zero, then you've got an inflationary sort of situation there. If there's a lot of money being pushed around, but if productivity is high, then it's not so bad. The two sort of cancel each other out almost, or to a large extent at least. So the money was being spent. Now, because there were factories closed, businesses closed, and so on, that meant that the amount of money people were getting was then chasing a smaller amount of goods because less was being produced. And that has a potentially inflationary effect. What didn't happen was there was no offsetting. The Chinese didn't ramp up their manufacturing. There wasn't an aggressive campaign to develop Western manufacturing to make up for the loss and so on. There wasn't a government effort anywhere across the West. And this is what the globalists wanted, I'm sure. Well, there wasn't an effort anywhere across the West to try and rebalance that equation and get people back to work and get factories built or production facilities in the West. That was a golden opportunity to rejig the supply chain configuration to suit the Western economies and the Western populace and the Western citizenry. But I don't think they wanted to do that, or maybe they didn't think about it, and let that opportunity be frittered away. The other thing with inflation is that if all that money had gone into, say, roads, bridges, public infrastructure, those sorts of things, then they tend to be very low on the inflationary scale because they're not direct consumption, they're facilitation, for example, a bridge, a road and so on. So if they'd invested in infrastructure heavily, I mean, real infrastructure, not black lesbian painting classes or, giving money to Black Lives Matter to burn down courthouses and things like that. If they put the money into real infrastructure, then the inflationary effect of that is quite low, and it's one-off. But that would be an example of a transitory type inflation that the propagandists in the Biden administration kept talking about. But because it went into consumption with a decreasing amount of goods to consume, with no productivity to offset the consumption, and obviously increasing the debt while taxation revenues were falling, then that's the inflationary spiral that we're in now. And again, the low interest rates have caused this overvaluation in shares and real estate, which has also reached a point where it has to unravel, and that may very well happen now. That's my take. You've been with Tacitus today, your Pushback channel, and thank you for listening.